Hello there, folks. Welcome into the four-piece, 4 videos for me to react to in this one here today. And my gosh, is it a gorgeous morning. It's about 63 degrees out here in Vegas this morning. Nice crisp morning that you would expect in October. So first video up here, Goldman Sachs mega cap tech. Historically cheap as earning estimates rise out of gold. So that's an interesting standpoint from Goldman Sachs. Looking forward to getting into that and seeing how they're judging that. Then we're going to listen to Bill Ackman talk. He was on CNBC earlier today, seeing lots of evidence of weakening in the economy. Want to hear what he has to say and kind of react to that and share my perspective. Jamie Dimon says JP Morgan can handle 8% interest rates. Geez. Could you imagine what mortgage rates are going to be at if the Fed funds rate goes to 8% or something like that? Like, that'd be crazy. And the last video up here, this is actually the one I'm looking most forward to getting into. Art Cashin, who's been around for like 800 years, okay? He's been around since the beginning of time. Art Cashin, October is the month of bottoms, he says. So looking really forward to getting into that one. I'm sure he's going to have some great insight. So appreciate everybody joining me as always. Thank you so much for being here. And thank you for being subscribed, folks. New all-time high subscribers in the history of the channel. Let's get into this.
Big tech now trying to turn a corner after the worst month so far this year, but some analysts are now saying that's a buying opportunity. That's the focus of today's Tech Check with Deirdre Bosa. Morning, Dee.
So on a price to earnings basis, mega cap tech, it's arguably cheap again. Apple, Amazon, Google, Nvidia, the rest of the Magnificent Seven, they have been hit by rising yields over the last month or so, along with the rest of the market, but their profit ratios have fallen harder. Now, if you exclude those 7 mega caps, the remaining S&P's 493 companies has seen its price to earnings ratio fall from 18 to 16. Now, if you look at the biggest names combined, they've seen that metric fall far more steeply, from 34 to 27 times. Goldman Sachs uses this chart to put all of that in historical perspective. The mega caps PEG ratio has fallen below that orange line on the screen. It's median since 2013 and also the lowest versus the broader market since early 2020. A discount that Goldman says has only been reached 5 times over the last decade. Now, a main reason for that is fundamentals. Higher yields make future earnings worth less, but that should have more impact on high growth, unprofitable tech. The mega caps are right now, they're widely profitable companies, even if recession fears are overshadowing AI hopes. And here's another interesting dynamic. Over the past 3 months, Wall Street.
All right, before we go further here, let me address the elephant in the room. Do I feel as a whole mega cap tech is cheap? And the answer to that is no. I feel mega cap tech, for the most part, is fairly valued. I feel like maybe one stock in that bunch is too cheap, and you know what stock that is. It's Meta. Outside of that, I feel like everything's pretty fairly priced in mega cap tech land. I feel like Microsoft, Apple, pretty fair price. Nvidia's at kind of a weird stage. Nvidia could be cheap. If anything, I'm probably leaning a little more toward Nvidia being fair value or cheap versus like overvalue, where a lot of people's mindsets are at in regards to Nvidia. If we think about Tesla, if you want to put that into mega cap tech, I think Tesla's pretty fairly priced right now. I'm trying to think. Amazon is pretty fairly priced. Yeah, so that's kind of my opinion. Google looks a little cheap, but they are dealing with government stuff, so there's kind of Google's probably going to be cheap for a while, to be honest.
Has revised up their earnings expectations. Analysts increased their outlooks for Nvidia and Amazon's profits by 60 and 20%. respectively, just over the last 3 months. Meta 14%, Apple and Microsoft, their earnings expectations have been revised down, but that may have more to do with visibility on newer products and technologies like generative AI and, of course, the Vision Pro from Apple. Now, the growth part of the mega cap equation, it's not much to write home about, but it is stable and it does beat the broader market. 11% revenue growth expected in the current quarter for the Magnificent Seven versus 1% for the S&P as a whole. And all of this is to say, guys, that while tech isn't typically thought of as a defensive play to play the markets, it may offer more protection than the usual hiding spots, as it did earlier this year, you might remember. In a longer-term, higher interest rate environment as well, those fundamentals that could underpin big tech. We didn't even get into sort of the stable management, the wide moats, and of course that generative AI push that could bring growth rates up in the future.
I guess the flip side of the argument, Deirdre, and why they've been so pressured is high rates and what that does to the multiple, right, when it comes to higher priced stocks. And that's always been a headwind for tech.
Exactly. And I think that you have to separate very profitable mega cap from the rest of tech, because what higher rates does, it makes those future profitability worth less. But mega caps, they're already extremely profitable. Plus, they have these huge cash hoards, right, which they're earning higher interest on. So I think that's why you can see them as more of a defensive play. But then you look at unprofitable tech or even less profitable tech with higher growth rates, and that may be less appealing in this kind of environment.
What's going on out here? Is it freaking Pearl Harbor? Is it D-Day out here? Holy smokes, man. All these planes and choppers flying all over the place. My goodness. Calm down. It's ridiculous. Oh my gosh. Anybody think we're ready for a battle? Okay. Okay. So, something interesting happened with big cap tech. Okay. Those companies, and if you're thinking about like, well, what about the rest of the market? What's going on with those companies versus some of these big cap techs? Remember, a lot of these big mega caps, they did huge cost cutting measures in kind of around the fourth quarter of 2022 and the first quarter of this year. And that's when a lot of their cost cutting huge measures went through. They did a lot of firing, things like that, right? Now, outside of those stocks, okay, when are those companies having their cost-cutting measures go through? Well, a lot of those companies had their cost-cutting measures basically going through in the back half of this year and into early 2024. So that's why I wouldn't be surprised to see a revival in, let's say, a lot of the value stocks, a lot of the dividend stocks, starting actually next year, potentially the end of this year, but even next year, I wouldn't be surprised to see a lot of them start to come back to life. Let's just put it that way, because their cost-cutting measures then going through and their profitability, and then people be able to look and say, oh, these businesses are stable now. They're getting their EPS back around, their margins back around. It's looking good, okay? So that's what I think is going to play out next year with value stocks and dividend stocks for the most part. It's just they're at a separate kind of time horizon than a lot of the big cap techs. Alrighty, next one up here, Bill Ackman, seeing lots of evidence of a weakening economy.
Interest rates.
Sure.
And where you think we really are headed, because you've made some provocative statements about where you think the 10-year is ultimately going to go, where this is all headed. I'm curious what you think that ultimately means to equities. We were just speaking downstairs about mortgage rates and whether they stay at the 7-8% level and what that, do things start to break as a result?
Sure. So two things. So one, I think the Fed is probably done. I think the economy is starting to slow. I think the level of real interest rates is high enough to slow things down. High mortgage rates, high car rates, high credit card rates, they're starting to really have, an impact on the economy. Economy is still solid, but it's definitely weakening. Seeing lots of evidence of weakening in the economy. What our belief when, the 2-year Treasury was 12 basis points was going to 5, right? We no longer have that bet on. The only bet, if you will, and it's really a hedge at this point, is that long.
Oh my gosh. I think it's a helicopter race. I think a helicopter race is going on. Oh my goodness. Watch out for the mountain, you freaking helicopter.
30-year Treasury is likely to go higher. Go into the mid-5s is our expectation of what happens there. I don't know that the 10-year has to go meaningfully above 5% because you're seeing some weakness in the economy. But on a long-term basis, we think structural inflation is going to be persistently higher. In a world like that, the government shouldn't be able to borrow at 4 3/4 fixed for 30 years. So I think long-term rates go higher. I don't think mortgage rates, the spread between the 10-year Treasury and mortgage rates is about the widest it's been. So you could see a world in which the 10-year Treasury goes up and mortgage rates don't go meaningfully higher than where they are now. A lot of that has to do with, I think,
when
volatility.
does this break the consumer, though? At some point, these 7 and 10-year arms and what's going on are going to roll over. People are going to have some problems, no? And then what happens to the regional banks? I mean,
most people, a big percentage of the country has, fortunately, fixed rate mortgages at 3.5%, 4% or less. A lot of businesses, a lot of the big companies have fixed rate debt that's extended for a relatively long period of time. So I think yes, there are people who've borrowed short term at a low fixed rate and are getting repriced. And you look at a lot of commercial real estate investors, they're going to have a very challenging period. I think that's really the big threat, a very targeted threat that rates will have.
Two other quick issues. Presidential election. You've been talking a lot about how you want Jamie Dimon to run. Jamie's not going to run, I don't think, but
I've given up on that, yes.
You've given up on that?
Yes.
But you're giving money to Vivek Ramaswamy?
I did.
Chris Christie?
I did.
You giving money to Biden?
No.
No. So what do you want to happen here?
I want an alternative to the choices we have now. And I think the country would be very well served.
With the choices that you don't want any of the people.
No. I think a Biden-Trump election is not good for the country. I'd love for there to be a candidate the entire country can get behind, as opposed to this, two-sided world that we live in.
Who do you like the most?
Of
all the people, you know the options.
Well, I don't know them all.
But I mean, you know of the options.
I've not met Nikki Haley. I'm going to have an opportunity to do that soon. I met with Christie recently, and I was actually really impressed. A real guy, super solid, governor, did, I think, a very good job dealing with the hand he was dealt in New Jersey. Was able to get elected in a Democratic state. I could see him as someone to bring the country together. Will he have the widespread appeal he needs in order to rise? I think, an early test will be New Hampshire.
Final question. You met with Zelensky.
Yes.
I think you're a supporter of Ukraine.
Yeah.
I think
yes. Big supporter.
Would have you liked the U.S. government this weekend to have funded Ukraine? And by the way, how does that square with Elon Musk, who I know has a very different opinion of Zelensky, I think?
I don't know that Musk has a negative opinion of Zelensky. I think his view is that a forever war in Ukraine is not good for America, is not good for Ukraine, not good for anyone. I agree with that. I'd like to see a world in which that war ends. It's a black swan risk for the world. There are thousands of young people and innocent people dying. I'd like to see a world where that ends sooner rather than later.
Okay.
Yeah, so Chris Christie, okay, come on, let's be honest. He's not winning, okay? Christie, I swear the only reason he even runs is just to talk trash about Trump. I don't know if you guys seen the recent debates and whatnot. Every chance he gets to talk, I swear, he'll somehow throw in some dirt on T-Man. Every single time. It's rather hilarious. But yeah, that man's not winning. It's going to end up being Biden and T-Man. That's the bottom line. The Vivek guy seems interesting, seems somewhat, I would say he seems somewhat with it. But the problem is, no one knows who the frick he is. And that kind of matters in a presidential election, as we've seen, right? Which is why we're going to have Kardashian versus Kanye probably for presidents in 20 years from now. Just wait on that. Next one up here. Jamie Dimon says JP Morgan can handle 8% interest rates.
I just tell people, be prepared for higher rates and slower growth.
7%. Are we really going there? And how does
I don't know. When I said 5%, they said, are we going there? Yeah, it's possible. So when I talk to my board, I say, yeah, can it go to 7%? The answer is yes. Are there factors that would drive it, higher than, where it is today? 4.5, 4.6, or 4.7 over the 10-year bond now? Yes. Is supply and demand could push high? Yes. I'm just saying, be prepared for it.
So
and then the worst case is stagflation. Higher rates because you have a booming economy and there's a lot of competition for capital is not the same thing as stagflation.
And by the way, that's a prudent action from Jamie Dimon there. And I think it's a prudent action from him, to say these sorts of things, honestly, not just because he's running one of the biggest, most successful banks in the world, right? But this man obviously went through the great financial crisis. He's been around a long time in the finance sector. A lot of people pay attention to what he's saying. And so I think it's smart to have somebody that is honestly maybe the most respected person on Wall Street, just to be quite honest, to have him out there and just cautioning everybody and kind of saying, hey, this could happen, and I think that's a healthy thing, personally. I think that's because at the end of the day, you'd rather have somebody be cautious than just, everything's going to be great and this is going to be good. And then all of a sudden that doesn't happen and everybody starts freaking out because the biggest banker in the world was way too bullish when he should have been more cautious.
What are the ripple effects of the stress of that? 7% rates on business, on your growth?
Well, I'm not worried about JP Morgan. JP Morgan, we are prepared. We can handle 7%. We can handle 2% again.
8%?
Yeah, we can handle that too. That risk management is not the same thing as guessing the future. When risk management, looking at the range of potential outcomes and being able to say to yourself, we can handle this, we can handle this, we don't really expect it, and we can handle the in-between. If you bet your company on, one outcome, so I think all companies do that, and every company's got different exposures, input prices, output prices, some interest rates don't matter, some it's the price of mozzarella. So, what's your business? Your business is different. So, but I think we don't know the effect of these things on the economy. So we may have a soft landing, we may have a mild recession, we may have a harder recession. Obviously there are potential bad outcomes. The worst one would be economically is stagflation, where you have low growth, high interest rates, and obviously if that happens, you're going to see a lot of people struggling.
yeah, no one wants to see stagflation. That's one thing for dang sure, okay? We'd rather get the recession out of the way or something like that than a stagflation situation. I honestly see there being the potential for a stagflation. I see there's a wide range of scenarios that can play out over the next 12 to 18 months. And I think one is actually stagflation, where you just kind of get this slow grind lower in CPI, but it's not quite to the Fed's target, so the Fed has to keep rates higher, and then the economy, grinds to a halt. That would be a rough situation to go through. So I think that's a potential. I wouldn't bank on that happening, but I do think it's a potential. So I mean, I see three different scenarios happen for next year. One where the economy is fine, earnings are fine. One where we actually have the recession hit and earnings get hit in the back half of the year. And I also see a scenario where you can get into some stagflation. So, but a lot of it will be determined upon what happens with the consumer, what happens with consumer confidence. Does the election play any sort of part in shaking things up in a substantial way, right? Because we know that's going to be a dramatic situation because one candidate's not liked very much. The other candidate, T-Man, is in a bunch of legal stuff that's going on in some very serious matters there. So that's a big question. I think that's got to be answered. No one knows how that's going to play out as of right now, to be honest. So, I mean, there's so many different things. If the Fed does start to lower rates at 24, when do they start to lower? How fast are they lowering? There's a lot to play here. Alrighty, our cash in October is the month of bottoms. Let's hear what this man has to say.
And for stocks, let's bring in UBS Director of Floor Operations, Art Cashin. Art, it's great to take your temperature again, especially regarding the market's fascination with yields. I guess you brought this to our attention weeks ago, but what do you think breaks the spell?
Well, I think what you saw, Carl, was recently the yield on the 10-year spiked suddenly up to 4.70, and then it recoiled and came back. And a lot of us old-timers said that looks very much like a parabolic exhaustion rally, that they peaked out and they're going to ease. And from that, we've got this multi-day autumnal rally in equities that popped up. Now, I wrote in my morning comments today that you have to be careful.
So what he just brought up there is actually a great point, because whenever you've gone through a long bull cycle on almost any asset, you usually have like a little blow off the top phase that kind of marks the actual top, right? You could go back to late 2020, early 2021 with all the SPACs, right? The IPOs, the unprofitable stocks, all those that were just being absolute animals, and those stocks were just flying to the moon, right? And they all had this like parabolic top kind of around January, February of 2021. And then a huge drop after that, and then obviously just a long drop. That's been going on. Some of those companies went BK, some of them are still around. Some of them, are going to make it and be fine, but, that was a whole mess to deal with. Real estate, many times you see kind of a last like parabolic move in real estate pricing, and then it starts to drop, right? And even in yields, you can see that many times when it's been through kind of a big bull cycle, there's this last like blow off the top phase, and that marks the top, and then we start to go down from there. So that's a potential, and I think that's a really, really great observation by Art Cash, and obviously the man's very, very experienced, so I love that he brought that to everybody's attention there.
The yield on the 10-year was creeping back up toward that 4.70. Now, if it goes back up to or through 4.70, that violates that whole idea that it was a top. So that would make everybody nervous. So what I said coming in pre-opening was that if the yield today gets up above 4.60, up into the 4.6364 area, it will put pressure on equities. And sure enough, what we're seeing is they get up to 4.65 briefly, and that cut the rug out from under the Dow Jones. So I think viewers at home, your yardstick or rule of thumb will be watch that yield on the 10-year. If it begins to inch up further toward 4.70, that'll put more pressure on equities. And if it eases back, that may give them a little bit of a sigh of relief, 4.60 or whatnot. And then just to diverge a little bit, Carl.
Yeah.
October is the month of bottoms. Okay, people talk about weak months and strong months. October is a month of bottoms, and usually they come after some kind of climactic sell-off. Now, I don't know if we can call September climactic, but ordinarily you will see in October.
Yeah, September was pretty bad. I don't know if you guys know the numbers around how bad September really was, but the NASDAQ, for instance, was down almost 6% in the month of September. I mean, usually you should expect the NASDAQ on average to make maybe a 0.5% to 1% move up or down in a given month, right? If you're going to average it over time. For the NASDAQ to make nearly a 6% downward move, that's heavy move down. Like, that's a big move down outside of a crash scenario, right? It's a huge move for just a month. So, I mean, obviously, I'll share my perspectives on this month in just a moment.
A bottom is reached, and we've seen it in, heaven forbid, 1987, and the crash of 87, the crash of 29, 62, we had the same thing happen. On and on again. For 60 years, I've been watching this thing. So somewhere in October, we're going to get a bottom. And where could that come from? Well, earlier you guys were talking about student debt repayments are going to start today. But guess what? In the middle of the month, on the 15th, there are billions and billions of dollars in tax payments that have been deferred on the West Coast because of absolutely dreadful weather a year ago. And on October 15th, billions of dollars in back tax payments are going to come due. So there's going to be a squeeze on the banking system. There's going to be a squeeze on liquidity, and that may be a factor on both bonds and stocks. So get ready for an adventure this month, ladies and gentlemen.
Oh, okay. When he says adventure, so he's basically calling for a crazy month of October, and he's basically still calling for a bottom in October, though, at some point in time. That it lines up with what happened last year. Market bottomed in October last year. It was kind of around the middle to late October. Market bottomed like clockwork. So I think it's definitely a potential that we could see the same phenomenon this year. And also remember what starts to play out around mid-October. You start to get earnings coming in. So you start to get it like a breath of fresh air, right? And all the world's not ending. Like, these companies are reporting earnings, and they're reporting good earnings, right? Big tech will be reporting end of October, beginning of November. So that's going to be healthy for the market, because I can tell you a lot of those company earnings are going to be very, very strong, right? Not necessarily all of them are going to beat, but they're going to be very strong earnings, and people are going to be like, oh, these companies are doing pretty good. So, and obviously a lot of the values and divs are going to be reporting, which, gosh, they really need to report. And so could I see October being a bottom for the market? Potentially. I think it's a pretty realistic assumption outside of some freak event, like, let's say, CPI climbed to the moon, or the core numbers climbed to the moon, or something like that. Outside of that, we should get a bottom in October. It makes the most sense. So appreciate everybody being here as always. Thank you so much, folks. Thank you for being subscribed to the channel. Much love. I hope we don't get a bottom in October, though. I'd rather just buy all the way into year end as cheap as possible and then have my hedges print money. Like, that would be my ideal scenario. But you can't always get it your way. So much love, folks. Appreciate you. Also, if you're looking to apply to join my private group, the Financial Fortress program, get access to all my courses and get access to the Discord chat, all those sorts of things. Then check out the pinned comment down there. You can fill out an application to join us in there. Much love and have a great day.